The circular flow of income is one of the most important models in macroeconomics. It shows how households and firms interact and how income, spending, and production are all connected. We'll begin with the simplest version of the economy, known as the two-sector model, before extending it to the five-sector model, which is a more realistic representation of the real economy. Now imagine that there is an economy with only two groups of people: households, domestic households, and domestic firms. There's no government, no international trade, and no financial sector. Now let's begin with the analysis on factor market. Households own all the factors of production: land, labor, capital, and enterprise. Well, firms require these factors of production to produce goods and services, the outputs. So households supply the factors of production to firms. In return, firms pay wages, rent, interest, and profit to households. Notice that two things move in opposite directions. The real flow consists of factors or production moving from households to firms, while the money flow consists of income flowing from firms to households. Using these factors of production, firms produce goods and services. These goods and services flow from firms to domestic households via the product market. The households then use the income that they have earned to purchase these goods and services. Again, the two flows move in opposite directions. Goods and services move from firms to households, while consumer expenditure on domestically produced goods and services moves from households back to firms. Together, these two markets create a continuous circular flow throughout the economy. Well, in this simple economy, households spend all of the income that they receive. And that means every pound firms pay out as income returns to them as consumer spending. As a result, income equals expenditure equals the market's value of outputs. This is known as the macroeconomic equilibrium in the two-sector model.